Good evening, everyone. I can see you all rapidly joining us there. So thank you for joining. Let's just give it a couple more moments for people just to join. There's constantly people adding in here. Certainly lovely to see you all. Nice familiar faces there as always. Joe, I can see you in the background. Niels, lovely to see you. Nigel, loads of people here. Matt, you're in the background for a change. That's I think that's a bonus actually for today. So okay, so I think we'll get started. So we are a few minutes late in joining. Apologies for that. So can I just double check first that you can all hear me and that you can see the screen? If you can just wave, give me a thumbs up, blow me a kiss. Yeah, I can't see many kisses coming out there, but that's, oh yes, I've got one there in the background. Love that. Thank you, Andrew. Absolute pleasure to see you. So, okay, let's get going. So just to let you know, we're going to be running a Q&A session at the very end. So please do add any questions that you've got into the chat as we go through. I do like to keep these webinars to a maximum of an hour and a half. Appreciate we've all got lives to go away and have in the evening. So any questions that we don't get to by that time, don't worry. We've got a recording and everything will be answered after the webinar if we don't get to it. And something that I'm just going to put a little request out there for, as you're adding in your questions, if you wouldn't mind just saying whether it's for Steve, Dale or John, if it's specifically for one of the guys, and then obviously I can direct it to them. So let's go. So welcome everyone to the second Fabric Invest webinar of 2021. And thank you to each and every one of you for joining with us as always. So the topic for this webinar is Spring Brings Hope and Certainty Ahead. And I certainly tried to bring a bit of spring to the evening. I've got my pink on, and anyone that knows me will know that's a bit of a trait of mine. Everything's got to be pink. So we'll be going through this evening the latest property market news, the benefits and risk of investing in property, how to minimise your tax, due diligence and top tips for investing in property. And we shall be particularly focusing our attention on the Northwest and how your investment is predicted to increase by 28% over the next 5 years. So just now to introduce you to Fabric and the Heaton Group here. For those of you who don't know me, I am Lynn Whittingham. And as always, I'm absolutely delighted to be asked to host these webinars for the Fabric Property Group. For everyone who stays to the end of the webinar, we are giving away a free gift at the end. The guys never tell me whether it's 1, 2 or 3, so please stick with us, stay to the end, and you'll find out then and be able to claim that gift. So without further ado, it gives me huge pleasure to introduce to you today, and I'm just going to imagine the rounds of applause in the background, but please feel free to raise your hands and clap virtually. Firstly, the CEO and co-founder of the Fabric Property Group, Mr. Steve Jacob. From Fabric Invest, the Managing Director, Mr. Dale Anderson. And we're delighted to bring to you our very special guest today from the Heaton Group, none other than the CEO, Mr. John Heaton. Yay!
Thanks, Lynn.
Just have to provide my own audience here. So welcome, guys. Thank you ever so much. So Steve, I'm just going to start with you. Be nervous. No, it's all good. It's all good. So yeah. Steve entered the world of construction and business from a very young age and built himself a very successful company. Steve has sold in excess of 100 properties comprising of over 600 units and has been involved with commercial conversions, land developments and off-plan sales, to name but a few. Steve, I've got to say your business acumen is second to none. And you know that I think very highly of you. Dale has over 15 years of experience in the property investment industry and is a hugely trusted figure and well known for his honesty, integrity and professionalism. Dale has previously led and managed a team that sold 5,000 units and raised over £1 billion. Dell has experienced both the positive and the negative sides of property and certainly remembers the last property crash and how investors benefited. Dell's expert insights into the property investment market mean he's often featured in the media, on all the right pages, I will just say, as well as property news and magazines. Dell has also been interviewed by The Times, the BBC and the Daily Telegraph. And of course, it gives me the greatest of pleasure to also introduce to you all this evening, John Heaton. John has been at the helm of the Heaton Group since 1998. The Heaton Group is a 5-generation family run construction company set up in the early 1950s, and John and Adam Heaton's great-grandfather, Thomas Heaton. The business is now established as a very successful UK real estate company with over £100 million constructed and developed to date. So John, welcome to this evening. 5 generations, that's hugely impressive. Your company produces exceptionally good quality developments. Just tell us a little bit about yourself, if you will, and the Heaton Group.
Yeah, like you said, the Heaton Group, we've been going for since my great-grandfather set up the company. So my grandfather taking the ground then, and my father and both my sons work within the business with myself and my brother that's expanded the business over the last 25 years. So we are, we up until 6 or 7 years ago, we retained all the developments that we constructed and all the stock that we did, and we retained that for income generating purposes. So we have a large portfolio that our lettings management team, which are well versed in that, manage our portfolio and other investors. Every site that we do, we grow that portfolio because we retain an allocation of units within each development, and we drop them within the portfolio because we always see a capital growth in the areas that we develop, and we always see a strong return on the rental income. With in-house design and build team, so we have control completely. We're not just developer, we are the contractor and main contractor as well. So we've got architects, QSs, structural engineers, etc., all in-house, and it's coordinated from our offices in Wigan. We've run around about 250 tradesmen that we employ directly. So we have the resource and we've got cost certainty on every site. We completed probably 8 developments last year through COVID, finished the sales, refinanced the units that we was retaining, and fully let every single unit. The rental market's very strong at the minute. We're looking at bigger sites, more assets, in key locations throughout the northwest. And we're well versed with most of the banks know us as well as local authorities, and they help us through planning.
Perfect. Thank you, John. Thank you for that. And I see actually the sun is shining. Trees are blowing though out the back there in Preston today. So always good to see the sun shining anywhere. So I feel a bit, is it Chris Whitty? Next slide, please. Should we go with that?
So thanks for the introduction, Lynn. As always, very thankful for that, very kind words. So we wanted to discuss as you know, at the heart of Fabric and what we do, Fabric Invest, is market research. We do like to keep our finger on the pulse with the latest market news. So there has recently been some news. There's been the latest spring budget by the government. So we just want to keep things up to date and discuss how that's basically going to be affecting the market. So in terms of the spring budget, and obviously I won't spend too much time on it, you can read up and we can send you the information following the webinar. It's been a complex 2 years for businesses, for people working from home more than ever, having to adapt. There is a sort of level, there is seems to be optimism in the air now, as you said. The government's latest spring budget, what that means to investors basically is there's been a further extension on the stamp duty holiday. It was originally intended to end 31st of March. That's now been extended to the 31st of September. So what that means is there's an opportunity for, especially first-time buyers on new build homes, to benefit from quite a substantial saving on stamp duty, anywhere from £3,000 up to £15,000. Naturally, for buy-to-let landlords, they still need to pay stamp duty, but at the secondary rate rather than the top rate of 5%. So that seems to have helped stimulate the economy and the housing markets. I think what's also driving the market following the spring budget was the new mortgage guarantee scheme. So people can now get up to 95% mortgages. Now, the problem you have with that is 95% mortgages are great, and yes, we can get a mortgage now at 95%. We only need, a low deposit down, which is great for first-time buyers. But the problem you have there, interest rates are probably going to be around 4%, if not more. Whereas if you're getting a 75% mortgage and you're putting 25% down, you're only going to be paying as little as 1.75%. So I think that's something to consider. The third thing they've done, there's been support for regional investments, £4.8 billion fund committed to investments in town centres. Now, most of that money, it's called the Levelling Up Agenda. What that means is a lot of that fund is going to be put into town centres, in particular heritage sites, historical sites, culture, transport, trying to keep the high streets alive, basically, following the pandemic. So 1 billion of that is the Towns Fund Up scheme, and that's primarily focus is going to be the Northwest. So places like Leeds, Bradford, Liverpool, and areas such as Preston will benefit from that investment announced by the government. And fourth but not least is new MMC task force. MMC means modern methods of construction. And what they intend to do is increase house building, obviously help with carbon emissions and climate change with these new methods by incentivizing with tax breaks, 130% first year capital allowance for companies investing in plant assets and machinery that will help with basically new modern methods of construction. So that's quite important for the housing sector, because that means the government supporting and encouraging the housing sector. And that I think is what's kind of stimulating the growth. Secondly, you've got Savills revised UK housing forecast, 4% growth now expected in 2021. That was originally quite dull. They expected 0% growth, and partly because of the government's initiatives, they're now saying housing prices should go up by about 4% on average. So it originally was 0%, it's now 4%. What's driving that could be the short-term stamp duty relief. It could be the new mortgage schemes, or could simply just be that housing supply is diminished. So we'll get onto that later, and I'm keen to hear John's thoughts on that and Steve's. The Northwest, most excitingly, the cumulative capital growth there is expected at 28.8% by 2025, according to Savills residential forecast. And the UK rental market forecast, on average, is expected to increase 17% over 5 years. So yeah, that's just a brief summary of the spring updates and what's actually happening in the latest market forecasts. I think really what we want to know, and I'd be keen to find out Steve and John's thoughts. Maybe Steve first, on what do you think is driving the housing market at the moment, Steve?
Well, most definitely the housing market's being driven by the government incentives. That's definitely caused a lot of demand. There's also an undersupply of houses coming onto the market. I know from personal experience, John may agree, I've got a portfolio myself, and I'm getting calls from estate agents, auctioneers, however they get my number, I don't know. And they're saying that they just do not have enough stock to keep up with demand. With low interest rates, mortgages being given out, stamp duty holidays, and all these various different incentives, they're causing this demand. And, what a lot of this stuff can mean to the people that are listening to this webinar. I mean, Savills here saying 4% growth, I'm pretty sure it's more than that in the Northwest. Like, from what I'm hearing from contacts around the Northwest, property prices have gone up a lot more than 4% this year already. But what this means to a lot of the investors that are probably sitting on this webinar and looking at various different properties, a lot of the properties that are being offered by the likes of Heaton Group and others are being offered at the same price they were 12 months ago. But there's no doubt prices have moved since then. Do you know what I mean, Dal? But yeah, the main thing is the government incentives and interest rates.
Yeah. Okay. Interesting. And John, do you have anything on that? What do you think's driving the market?
I mean, we're seeing it firsthand. What's driving the market at the minute? I think there is a little bit of the stamp duty holiday, but with regards to sales, I mean, there is a massive undersupply and there's an over demand. I think we're seeing a shift in people moving to different properties after the COVID lockdown. We had our best year both on sales and rentals last year as well, and this year started at probably double the pace. So the rental we've done over the last 6 months, we've raised rents twice. So we're still going through that process now on our existing portfolio, probably circa 1,000 tenants. And sales last year was our best year last year through COVID as well. This year's even stronger. So we're just seeing that firsthand, which obviously is driving prices up. I mean, we're in touch with auctioneers, estate agents, so on and so forth. I speak to my brother Adam, who heads the acquisition team out. I mean, anything that's complete or near completion, you're seeing the prices rise. Anything that's land risky, people that's a little bit more adverse. Funding's not there as easily now in this market unless you're a reputable developer or contractor. We're seeing that.
Yeah.
Land prices are down, property prices are up.
Excellent. I think a lot of it's also driving demand is shifting slightly away from the city centres. We've seen a huge sort of dip in the London central market. Manchester city centre has become quite expensive. So we're finding a lot of people looking at tertiary areas such as Sheffield, Leeds, Preston, as opposed to the major city centres. So I think partly that and affordability. I mean, unemployment and economic conditions aren't currently great. There's going to be a bit of a boost to the second part of the second quarter of the year because there's a bit of optimism now with the vaccine rollout and things cooling off a bit. But effectively, what we're finding is a trend of people looking for lower entry and tertiary locations where they're getting a little bit of a higher yield, rental yield as well. So I do think that definitely has a part to play. So we'll move on to the next slide. This is the latest Savills residential market forecast as of March. So originally Northwest was around the 24%. It then got shifted up to 27 and now 28.8%. So they seem fairly optimistic. From Savills' perspective, a lot of it's a bounce back in Q2. There's been obviously a lull and a dip in prices, but now the markets seems to be picking up. And again, according to pre-pandemic levels, Oxford Economics forecast that bank base rates would have risen to 2.25%. By the end of 2025, they're now saying that the base rate's likely to have stayed around 0.5% at the end of Savills' forecasting period. So what it is really is low borrowing rates. I think low borrowing rates have a big factor to play, and it doesn't look like the banks will be again, imbalanced supply. If we look at the housing sector since 1955, if you bought property in the UK in 1955, you're doing really well. Average prices have gone up quite significantly. So I've been through a recession. I've seen prices drop, but I've seen them bounce back. And I think the UK market in particular, because of the imbalance of supply, there has been a consistent growth over a long period of time in the increase of prices. And what's driving that is really, as you said, John, the undersupply. The government, according to Office of National Statistics, needs to build an average of 300,000 plus homes a year. Last year alone, I think they only built 151,000 houses. So what's happened with COVID, and I'd be keen to hear your guys' thoughts on this, Steve and John, as you work in the development industry. I think there's been a more of a shortage now of good quality supply because a lot of the big developments of plans have been put on hold until COVID's over. People have been slightly uncertain. So I think what's happened is a perfect storm of with the COVID pandemic. The housing supply has probably decreased rather than increased, and maybe Brexit's played a part in that too. I mean, what are your thoughts on that, Steve? As Brexit, do you think Brexit affected the supply or COVID?
No, not really. I personally, and I'd like John's thoughts on this. I think that planning needs to be reformed. It needs to be streamlined. I think they take well too long to get planning applications through, and there's just so much red tape. I mean, John must go through this a lot more than myself. I go through it on smaller schemes. I don't know how he gets welcome, but I think if they streamline planning, stripped back some of the taxes. I mean, Section 106 tax is extremely heavy. Still payments, all these taxes, they strip straight from the developer's bottom line, gets put onto the sale prices, and ultimately makes it less desirable to be a developer. But that's why I don't think they're hitting their housing target. But again, this undersupply for investors is just causing a surge in demand. So it's creating property as an investor. It's a perfect storm. It's creating price appreciation, rental appreciation. But the government want to hit their targets. They've got to change the structure, I think, internally. But John, what's your thoughts on that?
Yeah, the planning. My thoughts are that the planning, the change in planning policy. So it's now you've got planning officers working remotely from home, and COVID being used as an excuse for their over workload. So the applications there isn't enough staff to deal with it, or enough professionals. If they're going to do it, they need to become more commercially minded and outsource that. So public sector notoriously slow. So anything that's coming through planning, the delay on that. Then you have Partel coming out now, where the renewables are insisting on, which is a massive cost on development now. So there's an additional cost which will drag prices up again. So if the site's being circa, it could drive it up circa 10% in build costs, easily. I think we've seen a rise over the last 18 months of 600 a metre in build costs. We're seeing that.
Okay.
Wow.
Yeah.
That type of thing.
Okay.
It's not changing anytime soon. I don't see planning being fully reformed and streamlining. They seem to be making it harder. And again, that's a perfect storm for investors, because we aren't going to be hitting these targets, I don't think, these housing targets. Soon.
Sure. Okay. Cool. Great stuff, guys. Yeah, I definitely think, like you say, the red tape around planning, COVID itself is causing a backlog with the planning department. And I know the government's working on easing restrictions, which is certainly help. On to the other thing we talk about is generation rent in the UK. And based on my research, the problem you have is your annual salaries since sort of the 70s or 80s has not kept up with inflation with regards to house prices. So you've got a pool of young professionals under the average age now you can buy a house, I think, is about 33. Again, depending where you live in the country. If you're in London, it could potentially take a lot longer, depending on your average salary. So basically, house prices have shot up. It's not great for people, because obviously first-time buyers still aspire to buy property in the UK. It's something they've always wanted to do, and they believe in as an investment for their family. It's a good thing to do, and unfortunately, salaries haven't kept up to pace. So again, that's caused is a huge amount of demand for renters, and renters need affordable, good quality accommodation. New build in particular provides attractive facilities. The technology's been enhanced recently into these new build developments. They're more sustainable, and it's key ready. So tenants can move in and they've got their white goods and everything else included. So just on those stats very quickly, according to JLL, rental growth is due to rise by 17% by 2024. Your average deposit for mortgage is now £48,000, and your average age is 33 years to buy. So what's that created is a massive pool of young professionals who need to be in cities or towns where they can find work, especially with what's happening now. Rural properties are a great idea, and moving to the country with your family, but effectively renters still need somewhere to work, somewhere to live where they can work, and places that have co-working space and facilities in case there is a lockdown. It's nice to know that they've got everything on their doorstep, and that's why new homes do provide. They're adapting with new homes now because of COVID, so they're starting to implement things such as on-site facilities to help with that. So on to the next slide. I'll let you take over on this, Lynn, just in terms of our top tips for investing in UK property, if you just want to shoot some questions over to whoever you think's more important, more relevant to the question.
More important.
And then
Who's more important?
It's more important to the question. Yeah, more relevant to the question.
I'll go straight to the audience then, Dave.
Yeah, exactly. So yeah, I'll hand it over, Lynn.
Thank you. So let's go with Steve first of all. Is it a good time to invest in UK property net right now, would you say, Steve?
Look, I think ultimately, whatever asset class you decide to invest in, if you've done your education right and got the right people around you, then it's always the right time to invest. But you've got to, do your research, and if you're not doing the research yourself, find people that you can, rely on. I'm not great at equities, but I've got people around me that I trust are quite good with the stock market, and I talk to them and take their advice. So yeah, it is always it's always a good time. I mean, interest rates being low make it a good time as well. And just as Dale's just shown, there's a massive undersupply of housing. So yeah, I would say it's a good time to invest right now. Yeah.
Perfect, thank you. I think I will just add to that if you are, as Steve said, looking to people around you and their expertise in the area, make sure that you do your due diligence on them and check that they've got a proven track record before you, certainly if you're going to part with any money for their services. So, okay, thank you, Steve, for that. And the next one is, what the effects of Brexit and COVID having on the property market? Dal, that's probably one for you, actually, I think.
Yeah, sure. So, I'll be completely honest. We, as a business, sales was certainly down at one point. It's mostly when there's a lockdown, because it's tough because people want to go and see the sites. They want to view the show flats. So what we've really had to do is adapt and use technology like we are now, with webinars rather than seminars, using Zoom for meeting clients, showing them around the properties. So there's absolutely no doubt in my mind it has had a slight impact on the market. But I think companies are adapting, working online, and accommodating investors. There is an opportunity for buyers, as Warren Buffett always says. It's a great time to buy during times of crisis, because sometimes you get better deals, developers are offering incentives. On Brexit side, I mean, I think COVID kind of took the spotlight off Brexit, if I'm honest. Everyone was very concerned about Brexit as, trading partner with the European Union. No doubt, that's going to have it's had its impact already. It seems like there's a bit of a path moving forward. But I haven't seen any negative effect myself, having been there the day after the Brexit vote. I said to my wife, "Oh no, business is going to be tough. Sales are going to be slow." But again, you'll get people who are optimistic, and they see it as a buying opportunity. The fundamentals are still there with any investment. It's about demand and supply. So irrespective of whether there's COVID or not COVID, it's terrible for the economy and businesses and, tourism and travel, and events industry. It's horrible what's happened, but people still need homes to live in, and people need homes to be in during lockdown. What has changed is their requirements of maybe where they're living and what they choose to live in or rent. So those are my thoughts on that. Yeah.
And indeed, the facilities that they have where they're living is so crucial now. But just want to pick up on a point that you mentioned there, Dale, about technology and the ability that, developers, people like us, that we're able to bring to life the development. We're across Zoom calls, etc., present investors with videos and a walkthrough video, etc. And I think investors are also learning, particularly overseas, that is the way forward. I know a lot of people generally like to visit the UK or whatever, their country of investment, but actually that's not always possible now, and it certainly hasn't been over the past years. So investors are adjusting to that as well, for sure.
Yeah, but we have noticed March, April now, with the lockdown restrictions easing, things are definitely there's a lot more activity. I think people are starting to relax a bit more with the vaccines being rolled out. I think that's played a big part. So hopefully COVID will be history soon and we can move on. But yes, all good. So I'll shoot to the next question.
So, Steve, I'm just going to jump back to you here. What are the potential risks with property investment? Now, how do we avoid these risks?
So the risks with property investment is, buying the wrong properties. You can, buying properties that haven't got all the right certifications. One of the biggest risks for property investments at the moment is not having the correct lettings manager. Lettings management is a heavily regulated sector and they're really cracking down on it. So you want an established lettings manager that can look after and manage the property efficiently. But look, if you've got the hardest thing for me, I made a lot of mistakes to start with. As soon as I had the right people around me, solicitors, accountants, planning consultants, if I'm doing anything now, I pick up the phone to John Heaton, if it's to do with construction or, funding, and, we have great chats and I get good feedback. If you've got the right people around you, you will definitely make less mistakes. You won't make any if you've got the right team. So the potential risks are, buying the wrong property or having the wrong person manage it or having the wrong person build or construct it. But, ultimately, if you've got the right team, it's fine.
Perfect. Thank you. Okay. You can just move
We'll
to the
touch
next
on
one.
the due diligence soon as well with what to look out for as well with new build. So, but yeah,
absolutely.
We'll jump on that again.
Yeah, this one, guys, I'd actually be interested to hear all three of your sort of views on this, please. What is the difference between the different types of property investments in the UK? Dale, perhaps you'd like to start us off, please.
Yeah, so my background is off-plan, new build. With new build, naturally, you're getting a 10-year build warranty. You can sometimes get preferential terms on the pricing, payment terms as well, low deposit down on exchange, balance at completion. So obviously with off-plan, the immediate risk is it's not built, it's off-plan. So you really need to work with good quality developers you trust who are well-funded, good track record. I think that's very important. It's not always about the ROI at the end of the day. It's about sort of what supports the return on investment. So that's off plan. New build apartments can be anywhere from 50 apartment blocks up to 1,000 apartment blocks. You've got towers, you've got smaller boutique developments like Bishopgate Gardens in Preston. And some of them are obviously during construction, close to completion. Bishopgate completes in July, so naturally that takes away some of the immediate off-plan risk. And then, probably more so, Steve can talk about HMOs, commercial retail. So HMOs is house of multiple occupiers where you can buy a house, fix it up. You can get multiple occupiers in there, maybe students at the local universities. Those can give very good yields, but what's going to happen with the HMO is the involvement that you have in it, and you either need a very good management company that's not going to charge you an arm and a leg, or you're going to have to be quite proactive in managing HMOs. So I don't know if you want to touch on that subject, Steve, with regards to your portfolio and different types of properties and how they perform.
Yeah, well, you've got residential, you've got HMOs within the residential sector, you've got industrial, retail, commercial, shops, and each different investment type, you need to do different types of due diligence, but every single investor should build themselves a nice base of buy-to-let properties prior to, because commercial property has some great benefits, great legal benefits, with regards to tenanting. But before the pandemic, I wanted to go heavily into commercial property. That was my, thing. That was how I was going to take my portfolio, and I still am going to take it there. But I never could understand why a bank was so enthusiastic around an investor that had a good solid base of buy-to-lets, because buy-to-lets, take a lot of management, and you're dealing with a regulated sector and you're dealing with people's homes, and when the pandemic hit, shops were taking breaks, and you couldn't pay their rent. They haven't got no customers, and I had like 5 or 6 shops, and it was, you know, touch and go, but they've all paid, and that's all sorted. But the residential properties the rents just kept coming in, because people classed their rent as a very important bill to pay. You know, food, shelter, you know, they cancelled their gyms, cancelled their mobile phones maybe, but paid their rent. And it it shone to me that I will always keep building my base of buy-to-let properties. So
my experience certainly on the student side, used to do a lot of purpose-built student accommodation. And with COVID hitting, that was a bit of a problem, because all of a sudden all the students were home and they weren't staying in the student accommodation. So also liquidity on that front, you know, so it'll probably get back to normal, but a lot of students now have changed their, you know, they want to live in a small student room. They might want a bit of a bigger space. So I know that market's been affected, but like you say, residential seems to have weathered the storm quite well. What's your thoughts on that, John? I know you've got some retail units as well in your portfolio. How do those perform, and, you know, what do you expect to perform well out of all the different types of properties you have?
Well, what we're seeing, we've over 1,000 tenants within our portfolio, so with a mix of houses, bungalows, apartments, higher end HMOs. So, you know, so in essence, they're developed out like our apartments. So it's a similar tenant profile. None of it's student. I think students been hit quite hard, back home, etc. We are higher end residential, so all that will affect in that area, if it's the best apartment in that area, it will always rent. It's just a matter of how much. What we have in the last 12 months is the demand has gone higher. People want to live in a nicer place, want to live in a bigger apartment, that type of thing, and that's what the tenant profile's got better. But with the rents have risen as well. So like I said, we've rose rents twice in the last 6 months, not all at once, but certain ones that are coming to the end of the tenancy, etc. And I think you're right. Anything off plan is that you've no maintenance bill for the next 10 years if it's been built properly, that type of thing. And then if you've got a good tenant in there that's looking after it, you've even less risk of that, and that's what we experience. So you've if it's an existing one or it's a renovation, if it's that type of thing. Again, I'll reiterate what probably Steve said in HMOs and students, how you manage, you know, so it looks good in a spreadsheet, but in reality, you can have some issues.
That's it. So I always say, like, you've got your base, which is your lower risk investment. I think residential is that right now, you know, apartments and whatnot. You've then got your secondary level of investments in property, because it's good to diversify, and that's going to be your HMOs and commercial, but, you know, potentially there's going to be a bit of a higher risk there. And then right now the office market's been naturally hit really hard, so I'd put that at the top of the ladder in terms of risk right now. Hopefully things will recover, but what we are seeing is a lot of office to residential conversions coming to the market. So yeah, we'll move on. So thanks for that. If you want to take the question, Lynn, to one of us.
I think actually, Dale, I'm going to hand this straight back to you with your expertise in off-plan.
Okay. Great. Yeah. Benefits of investing off plan, you know, like we said earlier, just to recap, you've got your 10-year build warranties. They're using new methods of construction which are sustainable. It's going to reduce your energy costs as well and your carbon emissions. You know, the government is trying to stimulate the housing market by the introduction of better mortgage terms and up to 95% loans on new builds in particular. First-time buyers tend to prefer new build because it's key ready. They can move in. You know, they don't have to worry about anything. Again, you can sometimes, when you buy in the early stages, you can benefit from some better buying incentives, choosing the best apartments, of course. So I'd say that's the key benefits of investing in off-plan, but naturally don't shy away from the due diligence and the risks at the same time, and make sure that you're looking at that seriously and you plan properly before investing.
So yes, just moving on now to what to look out for when investing in UK property. So Dale, if I can ask you to just take the lead on this one, but I am just very interested to hear at the end what Steve and John actually think as well. So I'll let you run through, but if we can just head back to the other two guys after.
Yeah, sure, great. So I'll just run through very briefly. These are the key points I'd look out for. Is naturally the developer track record. You know, we like working with developers such as Heaton Group because of the established track record and a long-standing track record. You know, you do get developers out there that are quite new and they've only been operating for a year or 2 years, and you know they've got new limited companies or SPVs for the developments, but they don't have the track record. So, you know, they might advertise some really attractive terms and big rental guarantees to get the sales in. But you run a risk of working with companies that are maybe less experienced, they've got less qualified construction professionals and surveyors. So definitely ask for the developer's track record, look at testimonials, look at online reviews and things like that. The second point would be payment terms. Typically, you should only be asked to put down between 10 and 30% during construction. You know, so again, payment terms need to be sort of lower deposit down, 20-30% maximum. The initial 10% should be usually covered by some form of build warranty and deposit protection. Deposit insurance protection, as I mentioned, usually a new build comes with a warranty which protects the first 10%. Sometimes there's other insurances in place on top of that. Expert advice, you know, always make sure you're working with professionals in your industry. Everyone we employ has a minimum of 10 years experience in new build and off-plan property, so you know they know what they're talking about, and they're constantly researching the market and doing their due diligence. So make sure you're speaking to people that know what they're talking about. It's very key. Rental guarantee risk. So this is quite an interesting one. A lot of developers offer rent guarantee risks, and I'm not saying, you know, we've got products that do have 2-year rental assurance, but you just need to make sure that they stack up and they're not built into the price, because, you know, you can run into some issues there where they overpromise and underdeliver. There's a difference between a rent guarantee and a rental assurance. A rent guarantee needs to be backed by insurance or, you know, a bond of some sort. An assurance is just a promise in the contract to pay a certain amount of rent per month or per year. So just go on Rightmove, go on Zoopla, check the market rates in the city centre, wherever you're looking, and make sure it's matching up and tallying with the property you've been sold or advertised. You know, because if there's a big discrepancy between the amounts of rent, so say they're going to get you £1,400 rent a month, but the true market rent is only £800, plus then you've got to pay a service charge and management fees off that. Where are they getting the extra money to pay the guaranteed rent? So that's one I'd definitely be cautious with. And then also ensure asset liquidity. I spoke about student property. So some of the issues you may have there, if you're just buying like a student room, for example, student pod, is liquidity. So you need to make sure there's future demand. You know, you might buy something for £80,000, but it's only going to be worth £80,000 in 3 years from now if there is a exit market. So you need to make sure that there are buyers lined up for these properties. And that's why, again, residential is probably safer in some of the asset classes. So liquidity is quite important. There's a number of other things to look for. We've got probably 150 unit checklist for our due diligence, probably one of the most thorough that I've seen. So, but, you know, these are the main core things I think you need to look at. And then, you know, obviously make sure you're working with the right people.
Absolutely. Steve, you got anything that you'd like to add to that, please?
Yeah, I mean, Dale's covered a lot of the stuff when investing in off-plan property, but you know, one of the reasons why I was so passionate to join with Dale was because of what I see on the market. I was literally shocked at some of the what people would say are our competitors and the, you know, shoddy due diligence they do. I mean, some developers are blatantly new and it's risky, and you know they would never even pass the first 5 minutes of due diligence. I mean, I only have to go on Companies House to make a decision on whether I want to work with someone or not. And I feel that these other sales companies can do that. They know deep down that they're selling risky stuff, and I don't think they're telling the investors that. It's honestly, and people go, oh, it's because it's your company or whatever, but honestly, there's some real bad sales agents out there, and I think look up their Trustpilot reviews. When you get the product, the developer product, go on Companies House and look at the developer yourself. I think Companies House has done a great job at highlighting. You'll be able to see for yourself. So if you're looking to invest in UK property, yeah, look at all these things. But if you're going for an agent, check the agent out as well. Like, it's such a big thing. And I mean, it's sad it's out there. It's going to it does actually make our job a little bit harder. But in the long run, we know we're going to outperform pretty much all the competitors that I can see.
Thank you. And John, I mean, is there anything else that, you know, what do you particularly look for when investing in the UK property market? What would you advise people to do?
Well, I think just us, we have slight advantages that we're based in the northwest of England. It's probably the most lucrative investment area of the UK at the minute, and it's set for high growth. We've seen that through each recession. Our portfolio stood the test of time. And I think just keeping it basic, we have the luxury of 30 staff in our letting management company, and we can test that market before we go and buy or develop there. So we already know that the demand's there. So we evaluate every site as if we're not selling it and we're retaining it. So we underwrite that site, and we're happy to keep all 130 units in Bishopgate or 60 in Bolton where we've done the DD. And the rent demand, you know, it's a good investment for us. And that, up until like 6 or 7 years ago, like I said, we retained every development that we did, you know, and we still would have been, but we've expanded. And just keep down to basics, test the demands there, definitely deliverability. So what Steve's saying there, I see so many pretend developers and contractors and very inexperienced, and you can just see that it's not going to happen. You know, see that many times. Do your due diligence on that as well, and agents and rent guarantees. Yeah, you usually find there's a bit of a catch there.
Yeah, I agree. Thank you, that's great. So just moving on here. Sorry, Dale, did you want to add anything further?
Yeah, I was just going to say on John's point, just to reiterate, they maintain a certain amount of their development, so they'll keep 30 units basically for their own portfolio. Now, what that gives me is confidence, because they're actually retaining the units for their own portfolio. So they know that the apartments will rent well and give them a good return, and then sell the rest to the investors rather than just selling them all to the investors. It's a good mix of buy-to-let investors, first-time buyers, and then also the developer actually retaining some of that as well, which means they're going to have an invested interest in looking after the block, making sure it's kept up to a good standard for the letting team. Yeah, that's it.
Absolutely. Thank you.
So,
yes, what we love about Preston, the sleeping giant of the Northwest. So, I mean, John, it's certainly fair enough to say you live in Preston. You've seen the city change over the past few years. I've certainly seen the quality of the scheme that you've produced in Preston. What future plans do you have for Preston and the Northwest?
Yeah, I mean, we're actually based in Wigan, but we identified Preston around about 6 years ago as a good investment area. Well, one, it's a city. I think prices are set to rise without a doubt. Rents we're achieving in Preston are similar to that in Salford, but the prices are a lot less, probably 2/3. And we're on our Bishopgate, so our fourth development in Preston over this last 5 period. So we know the rental market's very, very strong. I think we've raised the bar with regards to values and rents there, and we're seeing that happen. So we're achieving really good rents and sustained through COVID and through bad times, which is it is detriment to the market in Preston. I mean, I've just come back from Preston today, and Boris is opening things outside from Monday, and I'm watching the bars and restaurants, actually builders and workers setting out outdoor space, so you can see that it's getting ready, and there's a buzz about the place. I mean, there's a new retail that popping up now, different bars and restaurants, definitely in that industry. And we've another project that we'll have coming up after this one as well, which is a new build. So, and that's in the Art of Press, where Bishopgate is where there's a lot of public sector money going in there. New cinema, they're on site. I think they'll be on site this year. There's retailers that are signed up there as well, and all this has been happening in the last 12 months. And we're seeing the U-Clan expanding as well, so they've built new buildings. There's a lot of investment going there. So we are still looking for other sites there, because I think it's been very successful, and I only see it going one way.
Perfect. Dale, would you like to add anything else at all?
Yeah, so Preston, originally, when I looked at it before we started sort of investigating, I was like, Preston, I was doing a lot of stuff in Liverpool, Manchester, the usual places, right? But I started digging deep into Preston and doing a research, and I found, like, the first thing is your entry levels, right? So you can still pick up a one bed, for sort of 125, 130. The second bit is the regeneration is huge. They've got the Stonygate master plan. So there's £434 million being invested into the city centre. There's a £1 billion local economy projected growth. Again, you are within one of the better locations, the tertiary areas between Liverpool and Manchester. So as a transport hub, it's going to benefit from obviously the rail HS2. So it's going to shorten the commute time massively into Manchester, Birmingham and London. So it's a travel hub of the north. And yeah, it's got a very young population. There's a lot of economic factors there that I could run into in terms of the industries, local industries that we covered in the last webinar. So there's a huge amount going on. There's the university regeneration. They're going to be really turning the city centre into quite a modern hub. And I've actually got a map here of what's going on. With regards to Bishopgate, we are central to all the regeneration. Preston High Street's very close. Train station's 10-minute walk. You've got the university, 9-minute walk. And then you've got the £50 million Harris Quarter shopping centre development that will have a lot of restaurants, bars and facilities. So yeah, a lot of investment going on. Lovely city, huge potential. And I think it's one that's been overseen a bit, really, as an investment location. So yeah, really excited. Here's a few images just to show the what the regeneration is going to look like. So you've got your £200 million university master plan. You've got your urban park regeneration, and then that's the whole Stonygate urban village. We've got market reports based on everything that's happening in the city. So very, very interesting regeneration program there. And then the Harris Quarter, the new shopping centre, and the High Street regeneration. So yeah, lots of potential over the next sort of 5 to 10 years. Great city, and yeah, we're pleased to be working with the Heaton Group on their scheme in the city centre.
Perfect, thank you. So I think that's just about it from a presentation perspective. I just want to say a massive thank you, first of all, Steve, Dale and John. Very informative, massive value, and really appreciate your time. For those of you who joined sort of partway through, I've got various questions coming in saying, can we please send you the recording? Just to let you know, yes, absolutely anyone will receive the recording that registered for today. So I do urge you actually to take the time just to have a look back at the recording if you missed a chunk of it, because there'll certainly be a lot of information in there for you. So just a reminder as well, please, if you've got a question, please do put it in the chat. I've got a few coming through. It is the best way to get the most from things. Please don't assume that, it's a stupid question or someone's already asked it before, or, whatever. Please do put your questions in the chat. And as I say, we'll go through those. If we miss any, we will get back to you after this evening, so no problem at all. So just to run through, just flicking through, first of all the ones about please send me the recording. So, okay, Dal, this one's probably for you. What is the cost of insurance protection for deposits?
So in terms of the 10%, you're normally covered by an NHBC warranty or advantage warranty on new build. 10% protected. The other 20% would normally sit in a solicitor's account, client accounts, and then it's drawn down at certain stages of construction. There are some developers out there that will potentially insure the balance, but it can be quite expensive. So in most cases, your initial 10% is covered. There's no extra cost to that or anything, and then the rest is administered by the solicitors at certain stages of the build. So provided you're working with a good construction team and quantity surveyors, QS team, you don't really have much to worry about, and you wouldn't want to get, it'll cost quite a lot, I think, to actually get an insurance policy out on the balance, but it's certainly something we can look into for clients. It really depends. Yeah.
If that question was aimed at like the developer, was that question aimed at the developer? What the price is for insurance protection, or was that aimed at?
Possibly. I mean, let's give an answer on both fronts then.
I think John would be able to answer more, but I think the developer has to pay a couple $100,000 for. I think it must depend on the size of the scheme as well. What's that, John?
Your 10% insurance is covered by the warranty. But in our case, what we do is it's a fully funded site. Like I say, we have the site underwritten by the bank and the funder, and all proceeds go from the buyer's solicitor to our solicitor, and then they get passed to the bank, and that's monitored on a monthly basis by the bank's monitoring QS surveyor, and that's the best protect, better than any insurance that you can have. So there's the ability for the bank to step in and complete the project.
Yeah, I think that's really important. That's really important. Being funded, that I don't know if we touched on that earlier, but it's a huge thing, because the bank are not going to release any money unless John's at a certain stage, or any developers at a certain stage, and it just protects the investor throughout the process. And if the bank have to step in, take the site and carry it on with another construction company, they can at any point. So yeah, I guess that's right.
I think key is as well, Steve, is that, for the bank to grant the right of a lease, they expect the money coming, and that's how we have it set up, and it's the best way and most honest way of doing it.
The good thing is with that as well, I mean, we have a 150-point checklist, and I always say that if a development has been funded by a bank, no matter how much due diligence we do, these guys are going to have done a hell of a lot more, and that. We will still do our due diligence checks, but that is a big tick for Fabric, especially a reputable bank as well. So, yeah, good point.
Definitely, yeah. If it's bank funded, it means the banks have scrutinised the developer and their track record in order to fund them. So that for us is obviously very positive, because it means the project's fully funded and it's not fully reliant on investors' cash. If it's fully reliant on investor cash and a cash funded model, sometimes it can be a bit of a risk there. Yeah.
Lovely. Thank you, each of you. So next question is the re-emergence of 95% mortgages a worry in terms of bad debt risks and impact on the wider lending market?
I'll take that one. I think it's really irresponsible of the lenders to do that. Really irresponsible. We've already been here, 2008, and they need to learn from their mistakes. I mean, I'm geared at about 30%. So I've got about a 30% loan on my portfolio. I sleep at night. I'm happy with that level of gearing. I advise investors to be somewhere between 50 and 60% geared. I think that it's as if the lending market, it is, in my opinion, it is irresponsible lending, because some of the people coming into these markets are newer investors, and may just think that that's just the norm, you know, gear right up to what, you know, the highest you possibly can. And I just don't agree with it at all. I don't know how the other guys feel, but, you know, if you're an investor on here, you're looking to gear up, you know, 50, 60%, you know, is fine. And with these interest rates, that's great. But that's my thoughts on the lending market.
I think for me, these things selfishly, it drives the prices up because there's more money stimulating the market, and more people are buying, and the demand goes up. So that tells me banks are confident in the market, and also it's going to drive prices up because there's more liquid in the market.
Definitely, that will happen 100%. If it's easier to borrow, prices are going to go up. If interest rates are low, prices are going to go up.
I'd say on that front, on the 95% mortgages, I think that's more tailored for people trying to get on the ladder, especially in like the more expensive areas. So that's to help stimulate the first-time buyers market. But as a buy-to-let investor, and unless the maths, and you've done the maths and the calculations, and your rent's going to cover that 95% loan, you do want to be a bit careful there, because you could end up in a negative cash flow position. And as I touched on earlier, these 95% mortgages will be at higher rates. They'll be at 4% plus, as opposed to 75% mortgage, which you could get anywhere from 1.7 up to 3%.
Yeah, perfect. Thank you, guys. So next question is, how will the end of furlough affect the property market?
I think everybody's placing this big thing on people leaving the cities. I think the cities will come back. That's where the jobs are. You know, historically, property prices and demand is usually circulated around where the jobs are. Preston's great. Preston's got loads of major employers going there. It's one of my favourite cities in the northwest as an investment. Manchester's got lots of major employment there, Liverpool, and London's, you know, got, you know, all major employers there. So I think once the furlough's finished, I think you're going to notice unemployment is going to rise. However, I do think that will mean that I still believe the major cities will come back in time. I mean, unemployment's going to rise, I think, but I think that's why to keep your investments in major cities, your property investments in major cities, if you're going for a nice, safe, stable portfolio.
Oh yeah, I would say also commuter belts of the major cities. So places like Manchester, city centre might not be affordable now. So people will start to look outwards at Trafford or Salford, where they can get a tram or a train into the city centre. Same as London. I mean, that's been the case with London for years. A lot of people I worked with, we didn't live in central London. You commute from wherever you're commuting from, Surrey or, you know, the outskirts or Essex or wherever you are, into the city for work. I think probably people will be more flexible now. Maybe you have to go into work in the city 3 days a week, and then you can work from home 2 days a week. So I do think employers will start to be a bit more flexible. But ultimately, that's still, as you say, especially if you are in a bit of an economic recession or whatever, people need jobs. So it's all great having these good properties in the rural areas that you can do up, you know, it's all good. But ultimately, as a investor, the tenants, especially the younger tenants, are going to be coming in or wanting to have access into the city.
Absolutely, thank you. So got a lot of questions coming in here, guys, now. So next one is, I'm 10 years to retirement. Is it worth it to draw from my home equity in order to invest in a rental property?
It's a personal question. I think circumstance needs to be fully taken into consideration. Passing down property as a legacy is quite easy with property. You know, for example, if your properties are in a limited company, a cash flow positive, you know, protected in a limited company, you can sign the shares over to a loved one or a family member, retain your position on the board so that you are still heading that company up, you're still the director of that company. And if subject to living 7 years, I believe it is, you know, if you pass away, it's inheritance tax free, passed down to your children and loved ones. So it really does depend on your circumstance. If you're looking at tax planning for death, properties I think it's a fantastic vehicle, fantastic investment vehicle. But yeah, that question is quite specific. So reach out, talk to one of our advisors. They may need to put you in touch with an accountant or whoever. But yeah, it is quite a personal question.
Yeah, I was just going to say, thank you, Steve. I was just going to say that would be well worth you having a chat with one of our advisors, can speak through, your funds, what you have available, what you want to do with it, in what kind of term as well. So Steve's absolutely right. It'd be good to reach out to one of our salespeople. In fact, I'll make a note. I don't like to mention people's names on here because some people like to keep it personal and other people don't mind sharing. So yeah, the person that question came from will certainly make sure that one of our advisors gets in touch with you. Dale, sorry, did you want to add something to that at all?
Yeah, like Steve says, it is worth a sort of personal strategy call where we can really fully understand your circumstance. But we do, a lot of people release equity from property. I've done it myself. To buy other properties, especially when you're in a low borrowing environment. You could potentially release equity and then build your portfolio that way. But yeah, there's a lot of technicalities to it. So it's more about us fully qualifying your requirements and understanding your personal situation before you start to release equity or sell your property. Would really want to get to know you better.
Yeah, with him being 10 years off retirement, I don't know his age, but residential mortgages, they have like a cut off at like say 65 or 70 as far as they'll go. So he would need to talk to a mortgage broker to make sure that he could. There's ways around it. You can get like a mortgage host, someone younger who comes on with you. It might be a son or daughter. So again, it's real personal. Everyone's different. And, he could be saying retirement age and he could be 35 years old, or he could be 55, 60.
but it's safe as bricks and houses, as they say. So we still do believe, you're on the right track with property, certainly. But yeah.
I like that outside the box thinking there, Steve. Yeah, if you're 35 and coming up to retirement, just give me a call.
You're on the right track then, definitely.
Even though my husband's listening to this, but yeah, sorry, that just tickled me. But anyway, back on track. So there seems to be a high vacancy in Liverpool and Manchester apartments. How do you see the situation in Preston? And they also say thanks for the lovely webinar. So thank you for joining us, and thank you for your question as well. Who'd like to take that one?
John, probably. I'd like to hear John's view on because he's got lots of tenants. So
we're currently not in the middle of Manchester or Liverpool. I think people have moved out of those areas, and this is what we noticed in the last recession. So in the suburbs, it stood the test of time through the last three recessions that I've lived through. Early 2000, or 6 or 7, and now this one, which is bigger than, I think it could potentially have turned into a depression. But those areas have been sustained. I do think after the first lockdown, people my views was a little bit different. In last year, in 2020, after March, I think people was looking at working remotely, and certainly some businesses not going back. I think after this next lockdown, people are just sick to the back teeth and they want the social side of it again. So I see that demand going back into Manchester and Liverpool. But that still happens, Preston, Wigan, Bolton, all these other suburbs, Trafford, they all have their own sustained, social side of it as well, which is attractive. So I think some people will stay, but myself, I want to go out and I want to go and mix, have meetings, have a coffee, have some lunch, have a drink after work. I want that lifestyle back, and I think that's the general consensus of the UK at the minute.
I think as well, if you go and see the product that Heating Group put out there, and you go to every other development, you're going to know why tenants are going to want to stay in one of their developments. Like that is just, I think John said earlier, the best unit on the market or the best property on the market is going to pull the tenants in ultimately. Because for an extra 25, 50 quid or whatever it is, John, yours has got the concierge at the bottom. It's got the coffee place. It's got it's got so much for a tenant to do, a young professional, hasn't it? So tell us a little bit about the bottom there that's going to attract the tenants.
It isn't just a home, it's a lifestyle that we're creating in Bishopgate, and we're doing this on other schemes as well going forward. So we've engaged with, I think, independents as in retail, independent operators, the far more successful than a chain and a manager managing a shop. So we've got, there's Copypod there, there's co-working space. These are tenants that we're now signing up that have got good operators. We've interviewed like 6 applicants just for that one. Beauticians, barbers, hairdressers, that type of thing. Those uses are coming in now. So it's supporting uses of that building. We've got open space on the roof gardens, so we've had an eye on that since COVID. And we've also invested in a fibre company as well. So we know that we've got up to 250 meg up and download within that building, with an eye on people working from home or working in those communal spaces.
Yeah, I mean,
Amazing.
what I've noticed actually on that question, because Manchester city centre, let's face it, there's been a huge amount of supply, and a lot of that money's coming in from overseas and Middle East and Hong Kong. So there's all these towers going up. So that's generally we're avoiding the city centre. We tend to focus on like Media City, Salford Keys, because renters are now going to be hit in the pocket really with COVID. So, local people are going to be looking for more affordable pricing in those big cities, which will become quite expensive. And there's a lot being built. Whereas Preston, I only know of like currently probably 3 developments, new build on the market. So it's not at anywhere near the saturation or the supply level that you're seeing in the likes of Manchester or Liverpool city centre.
Perfect. So, John, just this is a long one, but I think this is particularly for you. So if I just take a deep breath and get through this, I know who this is from actually and why they would be asking this with their background, but here we go. So with everything that happened with new regulations since the Grenfell tragedy, what is the Heaton Group doing to keep up with rapidly changing regulations, such as sprinklers now being mandatory for building over 11 million and restrictions on materials used in the external walls? I haven't finished yet. A lot of blocks built in the last boom have been found riddled with problems, leaving residents with expensive repair bills and unmortgageable properties. I'm interested in how developers are looking to mitigate this risk moving forward, as I know the issue has caused investors to be nervous when it comes to investing in apartments.
Yeah. So the design team that we have, we design everything and every product is tested. So I think people's perception is cladding, and cladding's bad. In Grenfell, it wasn't the cladding; it was the cavity it was the cavity between the building and the cladding that was there, and there was no fire breaks in. So as long as it's a fire break and the material's tested, as you would again if you had a traditional brick and block build of a building, if it's got a cavity that's not filled with fire resistant material, that fire can go up that chimney and it will cause a fire, like in Grenfell. We all our materials tested. We will only buy products that are on the market and UK compliant. Throughout the building, even today, we have fire engineers that actually have sat on Grenfell Towers committee since this problem happening. They sign it off through each stage, and on completion, we produce an EWS1 form, which means it's compliant and it's built to full regulation. So, irrespective of what material it is or cladding, it's just as compliant and as robust throughout that.
Lovely, thank you.
Going forward,
yeah.
Interesting.
Guys, anything else to add to that at all?
I learned something there that was really...
It was good, yeah. It's what's called the EWS1 certificate that buildings need now. So what's happened, a lot of older buildings, and again, this is actually an advantage of new builds, because now with the new regulations, they have to follow the new regulations. A lot of the older buildings have had to redo the cladding or the materials under the cladding, and they actually now, what a lot of those buildings are doing, they've added that onto the charge to the landlords, basically. So they've bumped up their costing or their service charge And if you don't have that EWS1 certificate, you can't get a mortgage. So all the buildings that were built 10, 15 years ago, a lot of that's being put onto the owners and the landlords, A, the cost to get that, and B, it's causing them problems with selling because they have to find cash buyers unless the cladding's been sorted, right? So yeah, it is something that it has to be sorted, and on all the properties, you run the risk of having to pay for fixing the cladding.
Perfect, thank you. Just to let you know, I'm just going to go through another couple of questions because I've noticed the time. We do like to obviously respect everybody's time and not go beyond the hour and a half, but I do promise you that any questions that we don't get to, and there are quite a few, we will get back to you after this evening. So just one here. Oh, somebody joining there. So just one here. I'm based in Dubai and represent many investors, some of whom have already invested in London through me. What's your key push to ensure they believe somewhere like Bishopsgate is a better alternative, not just as a buy-to-let, but as somewhere they can use as a holiday home when they come to the UK?
Holiday home in Bishopsgate for someone from Dubai, that may not be the best thing for them to do, but for an investment purposes, I would say that it's probably a better investment than London at the moment, with for yield and for capital growth forecasts as well. But for holiday home, don't know, what's your thoughts on that, Dale?
Don't you like going on holiday in Preston, Steve? Actually,
I'm thinking of the Dubai. I'm thinking of the Dubai Sun, and I'm
thinking of Dubai. No, so listen, Preston is a city. There's a lot of heritage. There's a lot of green space. As a travel hub, it's a great location. If you're looking for somewhere affordable where you can position yourself to travel up to Scotland in a very short space of time, so you're in a position where you can get to all these cities in a very short space of time, and you've got all these facilities on site. So it's something you could probably use as a travel hub to get around England. And secondly, as a holiday home, maybe later on you just want to rent it out. Sometimes you can do long-term lets, short-term lets, but yeah, it's probably not, in our minds, it's probably not a place we'd use as a holiday home, but from someone from a different country or Middle East or Asia, it could be a good base for them to travel around all those heritage sites.
I think Dale's hit the nail on the head there. So maybe I overlooked it a little bit, but Preston is probably the best location to be able to get you anywhere in the country quickly. Like, you can get to Liverpool, Manchester, Birmingham, London, Edinburgh, all from Preston Station very quickly. And with the HS2 line now getting you into London in 60 minutes or 70 minutes, so yeah, maybe jumped a bit quick there. If you were using it as a holiday home, you can get to anywhere very, very quickly from Preston.
Yeah, I was just going to add to that, actually, Steve, you're right about HS2. So I think it comes into Preston in, is it 2026? John, you probably know more about when it's going to hit there. But certainly as an investment, I mean, by that time, that really, is going to be worth its weight in gold. But, at the moment, if the wind's blowing in the right direction and the sun's shining and there aren't any trains cancelled and all the rest of it, you can be from Preston to London within 2.5 hours. But actually, it's going to be about 77 minutes, I believe, at that stage. So, yeah, personally, I'd be looking to buy in early and reap the rewards of when that goes through that town. Any thoughts, John, on kind of staying in Preston to be able to reach the rest of the country?
I mean, Preston is capital Lancashire. It's right next to the Lake District, which is
true.
I go and spend
good point.
Weekends in the Lake District regular. I think as a bolt hole, it's good, but as a holiday home in the sun with a pool, I think that's what Steve was picturing it as. That's not what.
Yeah.
Absolutely.
So, better word, yeah.
So let's just get through one more. Okay, so Okay, so how can international investors go about managing their properties if it is possible to do so directly and independently?
Don't do it. Don't.
I love Steve's honesty.
International investors managing UK residential, commercial, bad idea. UK residential is heavily regulated. Like, you have to follow 7 quite clearly distinctive steps when onboarding a tenant. If that tenant then becomes problematic, you can't get them out. Someone like Heaton Group will have the processes and systems to ensure that if, in the unlikely event you do get a bad tenant, they can be out quickly and be replaced with a good one. Definitely not advisable for someone overseas to manage UK residential, I don't think, or commercial, to be honest. What do you think, John?
Our letting management company was born off bad letting management companies that we did.
Yeah.
So, and that's been going strong 25 years or more. But actually in Bishopgate, we've got our own another office, and our third letting office, which is within the building. So we're on site, we're managing it. But it's not stipulation of purchase. That team has got to impress whoever the investor is and win that business. So you're not bound by that, and you could use anybody else and manage it yourself. So
yeah, you're not restricted.
Not obliged.
Yeah, you're not obliged. You can listen if you're in the UK and you want to manage it yourself. Great, but obviously it depends how experienced you are in property and property management, and it depends. If you want to use another agent or a management company, yeah, you can do it yourself. But then it becomes a hassle. If you want to hands-off, relatively hassle-free investments, that's what we're here for. We make sure each development has a suitable management company, and developers like Heaton Group have been there, where you sometimes use a third-party management company that might not be that good or do the job efficiently enough, or they might not be focused enough on filling your property. Whereas Heaton Group have their own letting division, which means their sole focus is to make sure that building is tenanted with good quality tenants, and the occupancies are strong as possible.
I will agree that we've got in our own personal portfolio, we'll be owning properties within this building, so we're retaining units. We don't want a neighbour having a bad tenant and it being badly managed, because it's a detrimental effect on our unit or anybody else's unit. And we keep the freeholds as well. We have a block management company as well that keeps the maintenance and the upkeep of that building, and will do for its duration. So, and that we've set up that for a long-term as a long-term purpose vehicle for that on every development that we do. So the hallways, the external, everything, the management service, the insurance doesn't shoot up. It's a detrimental effect on us. But the building's it is well kept throughout the duration of that building. So our assets in there grow and grow and grow in value.
Right, thank you. So thank you everyone for your questions. I'm going to have to leave it there now with the questions, but we can see them there. They will get answered. Please have no fear. Steve, John and Dale, just to let you know, I've had numerous people coming through saying, love your webinars. Thanks ever so much. Really interesting, great value as always. So that's lovely to hear. Thank you for that. So Dale, tonight we're giving away a free gift, I believe. Would you like to tell everyone what that is, please?
Yes, so I'm feeling generous today. Maybe we'll make it 3 gifts. So yeah, we've got a lot of resources available that we invest quite a lot of time and also money into. So the first gift is we've got a UK investment property guide that we've just updated with all the latest market stats. So literally everything we've covered in this presentation will be covered in there, all the latest Savills data, JLL forecasts. We've done a bit of a summary. So UK Investment Guide 2021, we're going to be giving that away for free. And then also what we'll do is we'll provide a copy of the presentation to anybody who's interested in receiving a copy of the presentation we've run through. We're also going to put it live on YouTube. So we'll send a link if you want to rewatch it or share it with your friends. You're more than welcome. And thirdly, what we offer, as I mentioned, all of our senior consultants have a minimum of 10 years property investment experience. We provide a unique approach to property. It's very consultative, knowledge-based, and it's really to get to understand our customers personally, build long-standing trusted relationships. So we offer one-to-one strategy consultations via Zoom, if you like, if you're comfortable with that, or by phone. But it's always good to put a name to a face with one of our senior consultants who will then basically get to understand your requirements fully and provide you with the personal reports or recommendations on what we feel may be suitable for you, but also just to answer your questions and run through the due diligence and any other questions that you might have. So that's the three things we'll be offering. And we hope you found the presentation useful, and we look forward to hearing from you.
Great, thank you, Dale. So, as I said, they always tell me there'll be one, and then they deliver one or two extras at the end there, just to try and confuse me. So, ladies and gentlemen, not one but three gifts this evening. If you would like a copy of the UK Investment Guide, please put guide in the chat now, and we can get that across to you. If you'd like the strategy session with one of our property consultants, please put strategy in the chat. And if you'd like the presentation slides, just put slides in the chat, please, now. And of course, just to confuse you all, if you'd like all three gifts, please put bundle into the chat box now, and we will get those out to you. So finally, if you do have any questions, please contact your dedicated property consultant at Fabric. As Dale's mentioned, each one of us has 10 years experience minimum in the property industry, so I'd be happy to jump on a call or Zoom with you. So that just brings me to bring things to a close. Steve, Dale and John, on behalf of everyone here, a huge thank you for your time and valuable knowledge this evening. Very, very much appreciated. Text, I can tell you the chat is going absolutely mad with what people would like from the gifts, and also massive gratitude. Got to say, there's let me just scroll back. Got to make a point of this. There's one there somewhere. There we go. Look, massive thanks to the host. She was amazing. From somebody called Keith Whittingham. Just wanted to highlight that. Thanks, Keith. So yeah, just again, thank you everyone for being with us today. It really is truly appreciated. We absolutely appreciate your time. Your questions that you put over to us, it helps us too. So stay safe, stay well. We look forward to seeing you again very soon. Have a wonderful evening, and speak to you all again very soon. Take care.
Thanks, Lynn. Thanks, John. Thanks, Lynn. Thanks, Steve.
Bye-bye.
Have a good evening. Bye-bye.
Take care.